15 minutes to fix what I suggested even if you want to. So I would suggest doing it now, getting it over with, get your DCF valuation behind you. That's really the bulk of your project right there, because as we'll see, the relative valuation part is going to be pretty straightforward. It's not that complex. Okay. So let me finish off the last loose ends in discounted cash flow valuation. Before we left on Wednesday, it seems like a lifetime ago, I left you with a question, which is it possible for a company with small revenues and big operating losses, a young company, to become a valuable company? And the answer obviously is yes, of course. There are companies like Microsoft and Intel that at one point in time were companies with small revenues and big operating losses that are now valuable companies. And we laid out the template for making these companies valuable. We said the small revenues have to become big revenues. You need revenue growth. The operating losses have to become operating profits. You need a target margin that is a good, healthy margin. And you need some way of ensuring that your revenue growth doesn't get out of hand, that you're paying for that growth. And we use the sales to capital ratio as a way of kind of keeping things in check. Okay? So when we value young companies, those become the three key inputs: revenue growth, target margin, what kind of reinvestment goes with that. And those of you who use the high growth spreadsheet, you can notice the spreadsheet is built around those three numbers. So here's the valuation I'd like to use to kind of illustrate the process of valuing a young company early in the life cycle. This is a valuation from January 2000 that I did of Amazon. And to give you some background again, January 2000, the NASDAQ was at 5,200. .com stocks are the way. This is actually the peak of the .com bubble. And I'll give you some background on this valuation. I did this valuation for AIMR, for those of you who are doing your CFAs. Anybody here doing a CFA? No? Okay. AIMR is the parent organization for the CFA, which, if you've never heard of it, is actually a pretty involved three-level test to become a financial analyst. Right? So they came to me in early 2000. They said, would you be willing to do a webcast on valuing Amazon? Because a lot of our analysts are valuing young .com companies, and they want to know whether in fact you can do an intrinsic valuation, a discounted cash flow valuation of a company like Amazon. I said, sure. And this is actually the webcast. So I'm going to put you back in January 2000, and I'm going to take you through the webcast. The reason I'm going to put you back is as I go through some of my assumptions, you're probably going to say, that's incredibly optimistic. But at the time that I did this, I was accused actually of being incredibly pessimistic. So here's the starting point. In January 2000, Amazon coming into the valuation had revenues of $1.1 billion. That's tiny revenues for a US retailer. To give you at least a contrast, Walmart's revenues, of course, are $250 billion plus, but even companies like the Gap, the Limited, Costco's revenues are $40 billion. So $1 billion in revenues is small revenues. And operating losses of $410 million. So it kind of meets our criteria, right? Low revenues, big operating losses. My task was laid out in front of me. I've got to make the small revenues into big revenues. First assumption I highlighted in my webcast, this was actually a live webcast. As I said, I'm going to assume a compounded revenue growth of 42% a year for the next 10 years. I hadn't even finished saying 42% when the first email question, people watching the webcast were allowed to email in their questions. The first email question comes in. It says, how come you're being so pessimistic about future growth? Is it pessimistic? I'm making $1 billion in revenues into $40 billion. I made Amazon the 6th largest retailer in the world in 10 years, and I was accused of being pessimistic. You know why it sounded pessimistic? What were they comparing it to? Why did it sound low, 42%? They were comparing to revenue growth in the last year, which was 200%, saying, how come you're lowering the growth that much? But what they were missing was a compounded in the 10-year part. I actually was not lowering the growth to 42% next year. It was actually going to be 150% next year. But as the company got larger, the growth rate scaled down. 42% was a compounded revenue growth. I thought I was being incredibly optimistic. I also targeted an operating margin pre-tax of 10% in 10 years. That was actually the average margin of retailers like the Gap and Talbot, especially retailers. I said in about 10 years, once Amazon gets past through its growth phase, its margins are going to look like the margins of those retailers. Second email question comes in. How come you're being so pessimistic about future margins? It takes a lot of gumption to take a company that has a margin right now of minus 36.7% and accuse me of being pessimistic because I'm using plus 10%. But you know the story that was floating around then. If you're a .com retailer, you need less investment and you should have higher margins than a typical brick and mortar retailer. That was a story floating around. A story that never made sense, because here's why. If in steady state, .com retailers make 15% and brick and mortar retailers make 10%, tell me what you're going to do as a brick and mortar retailer. You're going to say, why the heck am I a brick and mortar? Everybody's going to be an online. In other words, you can't have two ways of running a business in steady state with different margins, because the lower margin version is going to disappear. The higher margin version is going to, at least they're going to compete against each other. So I present this argument, and this guy counters back. He says, so why didn't you assume that they'll all move to 15%? Because that's not the way competition works. You're a consumer. Now there are two ways of buying goods. You can go to a brick and mortar store, you can buy it online. There is no way you can tell me that the margins collectively for retailing are going to go up now that you have more competition. If anything, I'm being optimistic, assuming 10% is going to stay still. The reality is the margins collectively across all retailers are probably going to drop to 7, 8, 9%. So my optimist hat is still on. So revenue growth, small revenues become big revenues. As my operating margin goes from minus 36 to plus 10, my operating income goes from a negative number to a positive number. Remember the serious example where I set the ratio in each year? This was the most optimistic. Each year I moved half the distance to my goal. So my margins improved very quickly. I start turning the corner, at least in terms of profits, in year 3, 407 million. So I've got revenues, I've got operating income. Final loose end. I need to make sure that the company is reinvesting enough to sustain its growth. Make that estimate, I use the sales to capital ratio of all retailers, not .com retailers, but brick and mortar retailers. Across all retailers, for every $3 in revenues, they seem to have to invest $1 in capital, a 3-to-1 ratio. That was my last step. Every year I took the change in revenues. Take year 1. My revenues go from 1.1 to 2.8 billion. That's about a $1.65 billion increase in revenues. Divided by 3 gives me my reinvestment in year 1. Take the change in revenues from year 1 to 2, divide by 3, I get the reinvestment in year 2. I am assuming that reinvestment and growth are contemporaneous. Again, as we talked with the series, you can lag it if you want, but in retailing it's going to be pretty close. So every year the reinvestment is 1/3 of the change in revenues that year. So that gives me my reinvestment. I subtract the reinvestment from my after-tax operating income, and in my optimistic scenario, here's the scary number. Look at my free cash flows of the firm. Minus 931, minus $1 billion, minus $1 billion, minus 758. So under my optimistic scenario, my cash flows are going to be negative for the next 6 years, and only then will we turn the corner in terms of cash flows. Why? Because if you want revenues to grow this much, you're going to be pumping back cash into the business to keep the revenues growing. So those are my free cash flows. To discount those cash flows, I need a cost of capital. For the first 5 years, when I looked at comparable companies, I defined comparable as other .com retailers. Why? Because for the moment at least, that seems to be the overwhelming risk factors. These are small companies, big infrastructure investments. So for the first 5 years, I used a beta of 1.6. After the 5th year, though, here's what I changed. Look at the revenues in year 5. 19 billion, operating income off, about 1.6 billion. This is no longer a small money-losing company. This is a big retailer. I'm going to start treating it like other retailers. So after year 5, my bottom-up beta is estimated using special retailers, brick-and-mortar retailers, more mature retailers. It's actually a very good device to use with young growth companies, is you define comparable differently in those early phases when you're worried about, hey, will this company make it? Will there be a lot of risk? And differently later as your growth starts to create higher revenues, higher income, a more stable company. So my beta starts at 1.6 for the next 5 years. Beyond year 5, as the beta starts sliding down towards 1, you see my cost of equity go from 12.9 to 10.5%. So my cost of equity changes. For the first 5 years, I used a cost of debt, pre-tax, of 8%. Risk-free rate, T-bond rate then was 6.5%. Different environment, higher growth, higher inflation. The default spread was only 1.5%. That sounds like a really small default spread for Amazon until you look at how little debt they have. They have almost no debt, so the default spread actually reflected that. No. In fact, the way I computed the default spread was I cheated. How do we compute default spreads for companies that didn't have ratings? And Amazon actually didn't have a rating. We computed an interest coverage ratio, use the interest coverage ratio to come up with the synthetic rating, use the synthetic rating to come up with the cost of debt, right? See the problem I'm going to run into with Amazon with that approach? If I do my interest coverage ratio right now, my operating loss is minus 410. If I carry this to its logical limits, my cost of debt is going to reflect a D rating. The company effectively will be in default. It's going to be huge. So here's where I put my optimist hat back on again. I try to put myself in the shoes of somebody lending money to Amazon in 2000. I said, why would you be lending money to this company? Obviously, it's not based on how much money they made last year, because they didn't. They lost a lot of money. It must be based on your expectations of how much money they will make in the future. Not a great way of lending money, but that seems to be the only way you can rationalize this, right? If I use that rationale, though, how should I define my interest coverage ratio? You're lending based not on operating income last year, but expected operating income over the future. My interest coverage ratio should be based on expected operating income over the next 5 years rather than actual operating income last year. You're saying that's cheating. It's not. You're right. You have to cheat with high growth companies all the time. There is no simple device that you can use. So the way I came up with the rating is I used my expected operating income over the next 5 years divided by interest expense, which then gave me a triple B rating for Amazon, which gave me a default spread of 1.5%. So my pre-tax cost of debt for the next 5 years is 8%. My after-tax cost of debt for the first 2 years is 8% because I lose money. But in year 3, it stays at 8% because I'm carrying losses forward. In fact, I don't start paying my full tax rate until year 5. So my cost of debt changes both because my default spread changes over time and also because the tax benefits shift over time. So if you look at the after-tax cost of debt, it starts at 8%, ends at 4.5%. So my cost of equity changes because the beta changes. My cost of debt changes because my tax rate and my pre-tax cost of borrowing change. I said if I'm going to change the cost of equity and the cost of debt, why should I keep the debt ratio fixed at 1.2%? Right now, they can't afford to borrow money. They're a money-losing, young, high-growth company. But look at my own projections of earnings. By the time I get to year 6, year 7, year 8, look at how much money they're making. It makes no sense for me to leave them at a 1.2% debt ratio once they become a larger, more mature company. We talked about consistency a lot, before the break. It's not just important that you be consistent across companies. It's important that you be consistent within your own company as you project your company out through time. As you make it a more mature company with lower growth, give it the characteristics of a more mature company. And I push the debt ratio starting in year 5 from 1.2 to 15%. 15% again is the average across retailers. Notice something though, unlike the previous valuations where I drew on the company's numbers a lot to value the company, here I'm looking at industry averages a lot more. That's the nature of the process. When you value a young company, there's very little in the company that's going to be useful. You've got to look across the sector. So that's basically why my cost of capital starts at 12.84%, ends at 9.61%. I'm pretty much done. I've got my cash flows. I've got my cost of capital. Last step, I computed terminal value. Here again, my optimist hat is on. What number there is reflects my optimism of my stable growth assumptions. The growth rate is really high, right? 6%. But how do I get away with that? Look at the T-bond rate, 6.5%. Risk-free rate was much higher. What was really optimistic, though, was I assumed a return on capital in steady state of 20%. What I'm trying to say is every number here I've kind of swayed in favor of the most optimistic estimate I can make. But that goes in my terminal value. I discount the cash flows back. The value today of those cash flows is $14.9 billion. Add cash. Subtract our debt, I get a value for equity of $14,587 million. Options a problem? You can see, if it's, at least as a stockholder in Amazon, you can see how much of your company has been given away in the past. The value of options already outstanding, $2.89 billion. You subtract that out, divide by the number of shares, value per share that I get is $34. I know I've made a series of assumptions along the way, but in every assumption, when I had to make an assumption, I made the most optimistic assumption. Revenue growth, margins, cost of capital, sales to capital ratios, return on capital, and stable growth. And I'm emphasizing that is look at the stock price, 84. The value that I get is 34. And I'll be quite honest, this wasn't my first try at valuing Amazon. When I first tried, which is about 3 hours before my last try, I came up with $26. And then I heard that voice in the back of my head. You know what it was saying, right? They must know something that you don't. And I listened. So I moved my growth lever up to a more optimistic number. Then I moved the cost. In other words, this is not just my base case valuation, this is my most optimistic valuation. There's a canard about discounted cash flow valuation that you'll hear from analysts, that if you play with the numbers, you can make the value be any number you want. That is not true. If you follow the rules, that is not true. If you don't follow the rules and do whatever you want with the growth rate, of course, because you're creating money from nothing, right? So if you keep capex offsets depreciation and let the growth rate be any number, of course the value will be an unbounded number. From a discounted cash flow perspective, I cannot see paying more than $34 for this stock. So you ask me, well, how do you justify the $84? I don't have to justify it. I didn't pay it. So don't ask me to justify numbers I didn't pay. I'm not the prime defender of the market here. That's not my job. All I can tell you is what I think it's worth, and I'm saying I didn't buy it, so talk to somebody who did. Let them justify the $84. Maybe they have a really good story. But from an intrinsic value standpoint, there is no way you can justify $84. Any questions? Yes, Alex. Yeah. Expected operating income. So basically, I had the numbers already, right, up there. So I used my own projected operating income, divided by the interest expense, came up with a synthetic rating and a cost of debt.
So expected is average over 5 years?
Average over 5 years. If you want to use the average over 10 years, then you get a rating over the next 10 years. But because I want to revisit that after the end of the 5 years, I use the first 5 years to do the rating for the first 5, and then the next 5 years to do the rating afterwards. Okay. Any other questions? Yes?
Why did you have the return on capital at 20%?
As I said, that's my optimist hat. The first time I did it, I had it like 12%. I came up with $24, $25, and I looked at the price and said, maybe I'm screwing up big time. Let me go to the highest return on capital I can find for any retailer. That's how I picked the 20%. Is basically every one of these numbers I kind of tilted in favor of the best possible numbers because I was so far off the market price that I could afford to be daring on my assumptions and still conclude that the stock is overvalued. One final point, that $40 billion in year 10 as revenues, that actually is a key number driving everything, right? Because that drives around. The way I did that actually was I took the 10 largest retailers in 2000, I put a list of them, and then I said, assuming what I think about Amazon is right, and I was pretty optimistic about Amazon's future, where do I think Amazon will end up in steady state? So it's almost backwards. It's not like my growth gives me my revenues in year 10. I used that number to back into what growth rate I would need to get to that number. I mean, that's how you have to think when you have a young business. You can't think about what will next year bring. You have to think about what will success here define me as, and then work backwards. So how do I get there? What do I have to reinvest? What's my risk? What's the value of my business? Question?
So 30% is the reinvestment rate you have assumed for?
Yeah, because I have a 6% growth rate and a 20% return on capital. For the first 10 years, the reinvestment rate doesn't even enter the picture, right? Do you see why? Because the reinvestment rate is a percentage of my after-tax operating income that gets put in the business. And because I'm losing money, it makes no sense to even talk about reinvestment rates. In fact, as a general rule, when your margins are changing, the reinvestment rate is a computed number rather than the number giving you the growth rate. Okay? So for the first 10 years, the way I compute reinvestment is by taking the change in revenues each year and using that 3-to-1 ratio to estimate what I will need to reinvest to get to that change in revenues. Okay? And with young growth companies, don't use that return on capital reinvestment link until you feel that the company is in steady state. It's settled down, the return on capital is now going to be a stable number, then you can bring it in. And that's why after year 10, I switched to that to come up with my terminal value.
Okay. But could someone question in this case that 70% would be paid out as dividends?
It's not going to be paid out as dividends. It's a free cash flow to the firm, right? That 70% has to be used to pay dividends, buy back stock, pay interest. All your cash flows have to come out of that 70%. Yeah. So this is not, if it were a dividend discount model, I'd be focusing on return on equity and earnings per share growth. But because it's a free cash flow to the firm model, that 70% has to service all your different claim holders in different ways. Right? So it's only a small portion of it might actually be dividends. A lot of it might be stock buybacks. Some of it might be interest payments. You have 15% debt now. So a lot of different claims have to be met out of that 70%. So if you're faced with a young company, have fun. I mean, the reality is, you sit there with structures that are rigid, you're not going to be able to get out of them. So you got to make assumptions when you run into a roadblock. Make your best assumptions. Put them down on paper. Don't make them implicit. Don't make them invisible. Don't pull numbers out of the air. Put down an assumption. Move on. You can always revisit that assumption, but getting stuck on an assumption is a recipe for not getting a valuation done. So a friend of yours wants to start a business, say, will you value my business? Jump to the challenge. There's no better learning experience than taking a young company and kind of trying to flesh out the numbers. Right? At the end of this valuation, I get a pretty plaintive question from one of the people who was listening in. He says, is it possible that Amazon is worth $84? What's the answer to that question? Possible is such a weak word. Of course it's possible. In fact, there's a very simple way you can address this question, because this is a question you might be asked in any valuation, right? You do a valuation, it's different from the price. The person looking at the valuation says, is it possible that the price is right? Here's a simple way to do it. The two key assumptions in this valuation are the revenue growth assumption and the target margin assumption, right? If I change those assumptions, the value will change. So I decided to change those assumptions and look at what the value would be with a different set of assumptions. Here's an example. If I assume 50% compounded growth and 8% margins, the value goes to $40.50. If I assume 50% compounded revenue growth and 14% margins, you know what? $84 is a bargain. The shaded area tells you the break-even points in a very dynamic sense this particular company. So here's my conclusion. Is it possible that Amazon is worth 84? Yes. If it can grow like Walmart and have margins like Ann Taylor, everything's going to be fine. Now you make the decision as to whether you think that's likely. The question you should really be asking is not is it possible, but is it probable? And there the answer is the probability is really low. You invest in the stock, everything has to be perfect for you to break even. What kind of investment strategy is that? Everything other than perfection is going to be a negative surprise. I mean, this was my issue with Google at $700. I mean, you couldn't contest the fact that Google was a great company, a well-managed company with potentially a huge future. But at $700 per share, you needed perfection for the long term. 15 years of 30% returns on capital and double-digit growth to justify $700 per share. And you have to ask yourself as an investor, do I want to make a bet that that's what's likely to happen? And anything less than that is going to be a negative surprise. So young growth companies are a challenge, but kind of confront the challenge and move on. And the other thing about growth companies is revisit your valuation. Numbers will change, not because you screwed up necessarily in your valuation, that could be a possibility, but because the world around you changes. In fact, in the case of Amazon, I valued Amazon in 2000. You stay on the 2000 valuation. I'm going to show you a second valuation I did 1 year later. So 1 year later, AMR comes back to me again and says, will you value Amazon again? And here there was a different motivation. In 2000, the reason they wanted me to value Amazon is everybody was excited about buying .com stocks. They wanted to justify the high prices. But between January 2000 and January 2001, you know what happened to the sector, right? The sector basically collapsed. So the question they wanted me to answer now was, will any .com stock ever be worth money again? A very different motivation. So I said, okay, I'll try again. So this is 1 year later. Let me summarize what I'd learned about this business over that year. First, I learned that economies can go back into recessions. For a while there, I was lulled in early 2000 with all this talk of globalization. There'll never be a recession again. We've discovered the magic bullet for everlasting real growth. So we discovered something about the economy. We also discovered something about the sector, right? That the .com retailing sector was not a slam dunk winner. That many of these companies had no idea what they were doing. That they were online, they had a website, they sold stuff, but they weren't exactly efficient about what they did. I still remember my older son ordering a skateboard off an online skateboard retailer. You know, they're retailers for pretty much everything. So he sends the money off, and we wait 2 weeks, 3 weeks, nothing shows up. So he comes to me and says, Dad, I don't have my skateboard yet. So I get online, they claim it's been shipped 2 weeks ago. So I pick up the phone and I call the company and I say, we ordered the skateboard about 3 weeks ago and looks like you shipped it 2 weeks ago. We still don't have it. They said, we shipped it out. So what address did you ship it out to? I said, Ryan Damodaran. I said, that's right. 19 Maple Street. I said, that's right. Chatham, New Jersey. Yeah, that's right. Bosnia-Herzegovina. I said, what? You know what happened, right? They had one of those pull-down menus. And usually the smart thing to do is if 90% of your sales come from the US, you use that as your default. But they basically had a pull-down menu with countries, and my son filled out all the address through New Jersey. He never pulled down the menu for the United States. So there's some kid in Bosnia-Herzegovina on my son's skateboard. There's no way I'm going to go recollect it from him, But I should be glad it's not Afghanistan that was on top or Albania that was on top. That would be even more difficult to reclaim from. But basically my point is we discovered that .com retailing was a promise, but there was a lot of pitfalls along the way. So here's how I revisited the valuation. First, I looked at what Amazon had done over the previous 12 months. Okay? Here's an interesting test. I had projections for year one in 2000, right? Let's see how close I got to the actual numbers in my projection. So look at the 2000 valuation, look under the year one numbers where I projected the next 12 months. Let's see what the actual numbers look like relative to the projected numbers. Amazon delivered revenues of $2.465 billion. What did I project as their first year? 2 points. Actually, I got pretty close, right? Their revenues grew only 130%. Say that to yourself again. Only 130%. That's the power of expectations. When you expect revenues to grow 150%, growing 130% is a negative surprise. But they got pretty close. You know what they really killed me? In year one, what was my projected loss? I expected it to go down to $373 million. They delivered a loss of $853 million. They showed themselves capable of losing a lot more money for a lot longer than I thought they would be. So here's what I decided to do when I revalued Amazon in 2001. I brought down my revenue growth assumptions. I became a lot more pessimistic about what Amazon would look like in steady state. If you look at my revenues in year 10 now, it's now down to 23 from 40. So instead of being the 6th largest, now they're like 18th, 19th largest. I did lower the margins a little bit because the average margins for specialty retailers themselves had collectively dropped from 10 to 9.32%. So that's. If you go below the line, I've increased the beta from 1.6 to 2.18. It's a bottom-up beta. Why would it go up? You know what they really did during the year that changed the beta? Look at the debt-to-equity ratio. Close to 0. It popped up to 37.5% for 2 reasons. They borrowed about $2 billion. What's the other reason? The debt went up. What happened to their equity? This is a market debt-to-equity ratio, right? So the stock price drops. So you get 2 effects here. Debt increasing, equity dropping. The debt-to-equity ratio pops up. That's what's pushing the beta up to 2.18. I'm still bringing it down, but the cost of equity is going to stay high. The one thing that moved in their favor was the risk-free rate did go from 6.5 to 5.1%. As the economy slowed, interest rates went down. Cost of equity, 13.8%. The cost of debt, the default spread, which was 1.5% a year ago, is now up to 3.5%. Okay? Plug the numbers in, you can see that the cost of capital hasn't changed that much. It used to be 12.81%, it's now 12.77%. But the cash flows are actually a little better than they used to be. How come? How come my cash flows turned positive a little earlier than they used to? What's causing that? I mean, you're clearly losing money for a longer period. What caused the cash flows to be negative until year 6 in the 2000 valuation? Is that big reinvestment coming from revenue growth. So as I got more tempered with my revenue growth, one of the few bonuses I get out of this is the reinvestment becomes smaller. Take the present value. The value that I get is present value of my cash flows is 8.8 billion, which is what, about 6 billion less than it was a year ago. Add cash. They have a lot more cash. In fact, one of the things they did with their debt, which is I think a smart idea, is they borrowed money and they kept it in a cash balance. Survival became their biggest factor, so they held it as cash. Subtract out the debt, I get a value of equity of 8.17 billion, which is about 6.5 billion less than it was a year ago. Yep.
Why is the reinvestment going down between year 4 and 5?
Because the change in revenues became smaller. So it's a function of the change in change in revenue. So the change in revenues becomes smaller, the reinvestment is going to get smaller, right? It's basically whatever the change in revenues is divided by the sales to capital ratio. If you are an equity investor in Amazon, 2001 was a terrible year, right? Everything's worked against you. You see the only thing that's worked in your favor over this period? The value of the options, which were what, 2.9 billion, has now dropped to 845 million. Unless, of course, the company has decided that you haven't suffered enough and decides to take you to the cleaners one last time. By doing what? What did a lot of tech companies do in 2000 as the stock price dropped? They repriced their options, which is one of the most obnoxious things I've ever seen. I mean, I should use stronger words for this. So here you are an investor. You've lost 85% of your money. The company comes in and says, hey, you haven't suffered enough. Let me reprice the options. And what's the justification they gave? If we don't reprice the options, what will happen? They will leave. Who's they? It's not even employees. Let's be clear about this, right? Most of these employees have very little in options. Those 5 big guys at the top will leave. To which my response is, why are you stopping them? I've lost 85% of my stock price. I'm not interested in them staying around. Push them out, lock the door, don't let them back in. Don't give me this after the fact justification of, if we don't reprice it, they will leave. By this time, hopefully, I was assuming institutional investors had woken up to this practice, would not allow this to happen. If the equity drops, value per share that I got was about $21. In fact, as soon as I finish this valuation, I get an email question. Aren't you uncomfortable that your value per share changed so much over 12 months? And I said, after the last 12 months, I'd be very uncomfortable if my value per share did not change at least this much. And if you think, I've changed my mind, look at what the market did. In fact, by the time I did this webcast, the market price was down to $11.50. It had gone from 84 to 11.50. One of the things about intrinsic valuation is you will find this kind of manic depressive behavior on the part of manics. Overshoot, it'll undershoot, can't get it right. Yeah. Luis?
What surprised me is that most of the value comes from the terminal value in this case.
Why does it surprise you? When you buy a growth company, when do you make your money?
No, this is not what surprised me. What surprised me is why do you change the assumptions from one year to another?
Okay.
The stable growth should be the same.
No, but the risk-free rate changes, the inflation changes, right? You can't leave the stable growth rate at a nominal number as the rest of the world changes around you. Okay? So in a sense, stable growth rates have to, the real growth rate might not change, right? But expected inflation changes dramatically. There was a big shift in expected inflation as we went from the hyperheated, dot-com bubble to kind of a recession. So, but you have to keep your growth rates kind of consistent with your risk-free rates precisely for that reason. Any other questions? I've actually kind of tracked Amazon every year. I mean, I kind of left, I think, until 2005. So to show you what I mean about overshooting and undershooting, there's Amazon in 2000. That's the 8434, significantly overvalued. Amazon in 2001, significantly undervalued. In fact, right after I did that valuation, on the previous page, I was trapped. Trapped in what sense? When you do a valuation, you're always 2 questions away from being exposed as a fraud, right? First question is, what's the stock price? What's the second question, in fact, here? Are you buying? And if you say no, what have you just told the person that you've done the valuation for? I don't buy into my own valuation. Half my portfolio I've been trapped into buying. Because I'll do a valuation, say, are you buying? No, I have 3 choices. I can say no, in which case I've lost them for the rest of the presentation, because I can say yes and lie about it. They can't check. And sometimes I do that. I'm buying, but I never buy. And sometimes I do buy. In this case, I did buy Amazon because I looked at the valuation. And in a strange way, Amazon was in much better comparative shape in January 2001 than it was in January 2000. Do you see why? What happened to the rest of its competition? Gone. And in fact, the brick and mortar retailers were planning their online sites, all were using Amazon as their vehicle for doing it. So in a strange way, you can argue that the fact that it survived and come out of this puts it in a pretty good position looking forward. So I actually did buy in 2001, held through 2002, and I revalued it. Both the value and the price had gone up. 2003 summer, price shoots up again. This is, with growth companies, this is something that I've seen repeatedly. Okay? In fact, the reason I finally gave up on Amazon in 2005 is by 2005 it was behaving like a regular company. You didn't get these manic movements, which are good for you as an investor, because these are the ways you make money, right? Of the movements from being undervalued to overvalued, overvalued to undervalued. Since 2006, those of you who've seen on my website, you've probably seen the Google 2006, 2007, 2008, 2009 valuation. And Google 2006, 2007, 2008. I found it significant, very much, it looks very much like the Amazon 2001 valuation. The 2009 valuation, and I haven't put that on my website yet, I did last week, came up with I think $322 per share. The stock is at 326, somewhere over there. And this is the first time in 4 years. I'm not ready to buy yet. I mean, but my guess is that you're probably going to see it at 160 before you see it at 650. I mean, that's the nature of this process. Is when markets get disappointed, the kinds of investors who buy these companies get disappointed really quickly. And when they get disappointed, they have absolutely no patience, and you can almost guarantee that they will be dumping and running. And much as I hate to say it, that's the time to buy, right? So with growth companies, what I'm saying is if you're valuing a growth company, don't give up on it. Even if it looks undervalued, revisit that valuation 6 months from now, 1 year from now, 2 years from now, because who knows what can happen to it. Any questions at all on valuing growth companies? Anthony?
I just had on the cost of equity, the first time you did it, you said you're going to do it for 5 years and then adjust. But on the second one, you still did the 5 year. You didn't do 1,
4 and 5.
And then 6.
I mean, you could, but in a sense, that's a question of whether 9 versus 10 will make a difference. If you're doing a 3-year growth period, then it might make sense to revisit it. If you're doing 10, given that the growth starts to taper off in the second half, I don't think it makes much of a difference whether you do a 9-year growth period or a 10. Hey,
As this has become a more mature company, have you just given it one cost of equity?
basically, it'll end up, now when I value Amazon, I just use a 5-year growth period. It's the first period is gone. I don't need a transition phase anymore. Here's an evaluation, and this is a fairly traditional valuation, but this is a valuation of a pharmaceutical company. What I want to use this valuation to kind of illustrate is the effect of capitalizing R&D. We talked about R&D capitalization earlier in the class, but kind of standing alone. I want to actually value Amgen with R&D built in to CapEx, with all the adjustments you talked about. Then I want to show you what the effect would have been on its value per share if I'd valued it the conventional way, using conventional accounting numbers. So here are the numbers for Amgen. This is again from May 1st of 2007. I have an update of this valuation from last week as well that I'll let you in on. Okay. Here are the key numbers. The traditional accounting CapEx for Amgen is tiny, $255 million. So if I go to the statement of cash flows, look up the CapEx number and depreciation number, it looks like Amgen is reinvesting nothing back into the business. But that's because accountants define CapEx the old-fashioned way, land, building, equipment, machinery, and that's not how Amgen is investing. In fact, its two big reinvestment numbers are R&D, $2.2 billion, and acquisitions, $3.975 billion. They made 2 very large acquisitions in 2006 that pushed up those numbers. So when you see a reinvestment here, a net capex of $6.443 billion, the reason there's such a big disconnect between the number and the $255 million is I'm expanding my definition of capex. It might seem like I'm being unfair to Amgen. I'm actually trying to help it out because by using this higher reinvestment, I'm in a much better position to argue that it can grow faster in the future. So when I use a growth rate going forward at 9.6%, a lot of that comes from the fact that I'm assuming this much broader measure of reinvestment. I wouldn't have been able to use this kind of growth rate if I trusted the accounting numbers as the be-all and end-all when it came to reinvestment. One reason my reinvestment kind of drops off from last year to this year, notice it's 107%, which means in 2006 they actually reinvested more than their after-tax operating income back, is a big chunk of that reinvestment was acquisitions. Those of you valuing companies with acquisitions, probably if you look back over time, notice that the acquisitions are kind of a lumpy process. You have a big year for acquisitions, no acquisitions. I actually went back over the last 5 years for acquisitions simply because I don't think what they did in 2006 is what they're going to do every year. There's no way they can sustain it. So part of the reason the reinvestment rate came down is I used an average acquisition amount over the last 5 years to come up with my reinvestment. Okay. So the reinvestment rate of 60% here still includes R&D, still includes a normalized acquisition number, still includes traditional capex, but my growth is driven by that. That really is the only big difference. The rest of the valuation follows conventional lines, right? So beta, cost of equity, cost of capital. But capitalizing R&D made a big difference, not in my free cash flow to the firm last year, but what my perceptions of growth are going to be in the future. It also made a difference in my return on capital. My return on capital, if I did not capitalize R&D, was much higher because you don't reflect the value of your research asset in your capital than the return on capital I came up with. The 16.7% reflects the research asset treated as part of capital. Okay. Bottom line, with those numbers built in, the 9.6% growth decreasing down to 4%, stable growth rate, gives me a value per share of $74.33. Stock was actually trading at 55. Right? Another stock I invested in, which is now down to what, 52? Something like that, 51? I think it's 51 and 52. Actually, it's what over the last 2 years, if all you stock did was go from 55 to 52, you should get down on your knees and thank God I bought this stock and not that Citigroup that looked equally cheap at that point in time, right? In fact, did you see that FT article today, market caps of banks? You should take a look at it. It's a truly depressing article. It's got the 50 largest market cap banks from 1998, I think, and the 50 largest market cap banks today. And you can see the comparison of the numbers and where they've fallen. It's amazing how much market cap has been eaten away. Huh? So, but the key here is the R&D adjustment made a difference. In fact, the reason I did this was often people say, well, if you capitalize R&D, the free cash flow to the firm doesn't change, so why bother? Here's the reason I bothered. With no R&D adjustment, this is what the numbers look like. With my R&D adjustment, this is what the numbers look like. With no R&D adjustment, their operating income looked a lot lower. The invested capital looked a lot lower. Their return on invested capital actually was even because the drop in operating income was so much that the value per share was $42.73. When I capitalized R&D, the value that I got was $74.33. So if I'd followed the traditional accounting numbers, the value I'd have got would have come up with a value lower than the stock price. The stock would have looked overvalued. It's because I'm capitalizing R&D that I'm really getting the $74 as my value per share. And that's why we do it. It gives you a clearer sense of what the company is reinvesting, what it's truly earning on its investments, and what the value per share should be for the company. Okay? So you run into a pharmaceutical company, a technology company, consulting company, any company where traditional CapEx doesn't capture what they're reinvesting, I think it pays off to actually do the conversion and bring it into the numbers to get a clearer sense of where you're going. Okay. So you, yes, go. Yeah.
When we do this, when we capitalize R&D
Mhm.
or assume lease as debt,
Mhm.
the problem I was having was comparing it with the industry standard in the long
Yeah,
term.
that's.
How do you?
I think that's a good point. All my industry averages, I took the lazy person's way out, right? You know what I mean? When you look at the debt ratio for retailers, I'm reporting the conventional debt. You're using a debt ratio that's doing the right thing. So what I should be doing actually is computing all those numbers with leases treated as debt and R&D being capitalized. It's actually not difficult to do if the raw data exists. And in fact, Capital IQ, I can probably do it. So the next go around, I'll probably do the industry averages with the numbers embedded in them. But I also have to report the numbers without those numbers embedded in them because a lot of people who use those data sets stay with the conventional measures. So I'm kind of torn as to what to do here. So I'll probably report 2 returns on capital, 2 margins, 2 debt ratios with 2 different definitions because it depends on how people are defining it. Huh? Now, you guys mostly are done with the DCF valuation. When you're done, did you feel very comfortable with your value? In fact, let me give you 2 choices, and you tell me which one comes closer to describing how you felt after your valuation. I knew what I was doing, so the valuation I got was precise. Anybody here share that point of view? Thank God. Right? No matter how much care I took and how much time I took doing my valuation gives me an estimate. Right? That's the reality. Uncertainty is part of the game when you do valuation. Okay? The question is, what do we do about it? Let me give you 5 choices. You come up with a valuation, and this is not just for a project, so you actually are going to have put real money on this. Okay? So you're looking to say, well, what do I do about this uncertainty? Okay? I'll give you 5 choices, and you tell me which of these 5 choices you think offers the most promise in terms of the next step. You could go out and collect more information, right? Maybe that'll create more certainty. You could make your model more detailed. Start adding line item by line item. Maybe that'll add to the uncertainty. You could do what-if analyses. It's so easy to what if this, what if that, what if that, and maybe that'll make you more certain. Or maybe you can use crystal ball is still free for you, right? At least if you're in school. So, oh, that looks good. Let me do some crystal ball, Monte Carlo simulations. Or you're this the type of person, if you say, if I'm not absolutely certain of about what the value is, then I will never buy the company. In which case, you're never going to buy a stock, right? Because the reality is when you value a stock, no matter how much work you put in, you're going to be uncertain. So let's look at the 5 choices. Let's go item by item. You could go out and collect more information. The problem, I think, with this is collecting more information creates potentially contradictory information. You're collecting information, it doesn't all lead to convergence. You actually get more uncertain sometimes rather than less uncertain. The second is, and I think this is a reality we have to factor in, is as human beings, we have only a certain amount of information we can deal with. That's why 10K should scare you. You look at that 1,000 pages, oh my God, I can't deal with this, right? It makes you it makes you panicked. It's very difficult to actually sit there and work with 50 different numbers coming at you at the same time. Personally, I will not add to information unless I'm looking for something specific. The worst thing you can do is go to LexisNexis, type the name of your company, and see what comes out, because you will get a bunch of data but no information. So if you're going to go add to the information, be focused. Say, this will help me. I'm going to go look up that piece, and then I'm going to stop there. I'm not going to keep digging around looking for anything else I might find, because what you might find outside of that might actually hurt you rather than help you. But if you can find more information that makes you more, that you think will help, go look for that information. It's there somewhere. Right? Second, you can try to build bigger models, but as you probably already know, I'm not a great fan of bigger, more complex models, because at some point in time, it's so easy for these models to do contradictory things and you can't see what's going on. So you add 16 layers for working capital, 12 layers for capital invested. It's so easy for something to happen in the background that is not right, and you can't even spot it. I mean, my rule of detail is don't add a layer of detail until you can answer the question, which is what additional information will I have to estimate that line item better? So if you're going to break working capital down into accounts receivable, inventory, and accounts payable, ask yourself this question. Do I have some information in this process that will tell me that the accounts receivable changes over time? If it doesn't, all you've done is added 3 line items on which you're going to build in the same assumptions over time. Okay? The other thing to remember, it's not just about next year, right? You can add more detail for next year and come up with a better estimate of the cash flow next year. But if you're going to build this detail in for the next 10 years, you got to ask, can I really do this in year 2, year 3, year 4, year 5? Days of accounts receivable, days of accounts. I see items like that in valuation, and I say, well, how do you know what that'll be in year 7? Why are we bothering with these numbers if we really can't build them into the long term? So build more detail, but only if you feel you can bring some new information to that line item. Okay? You can do what if questions, right? What if this, what if that? Best case, worst case. I'll save you the trouble. Under your best case, your stock is worth a lot. Under your worst case, it's worth nothing. End of story, let's move on. The reason people do this is to cover their rear ends. Because if you've done a best case and a worst case, you put it into a folder and you file it away. No matter what happens, you're covered, right? Look, it's under the best case scenario. It's under the worst case scenario. Okay? So asking what if questions about what's the best case, what's the worst case, especially in the context of equities, does very little, unless you find that exceptional company that is actually priced lower than your worst case. I've never found a company like that, but maybe you'll find one. Okay? So you do your worst case scenario, you come up with a value of $12, the stock is trading at 8, you found an incredible bargain. But that's very unlikely. Simulations. I love Crystal Ball. It has the greatest looking pictures. I don't know what to read of them, but you can create some great looking pictures. Have you ever used Crystal Ball in DCF valuation? It's very easy to use. Learning curve, almost nothing. Hey, this is how it works. How many of you have used Crystal Ball? Hey. If you've used Crystal Ball, basically you can take any Excel spreadsheet and make each input. So when it says revenue growth, instead of entering a number, you enter a distribution. But here's the catch. You got to pick the distribution you want, and Crystal Ball gives you all these choices, right? Exponential, Y-ball. You have no idea. Most of the distributions you've never even heard of before. And then you have to estimate the parameters for that distribution. Most of the time it's garbage in, garbage out. Great looking garbage, but garbage in, garbage out, right? You're sitting there saying, distribution, what the heck knows? Looks normal. Let me pick normal. Normal is always safest because you need only 2 parameters. And you've heard about those parameters before. You pick something like a Weibull distribution. You've never even heard of the parameters. So what's a lambda? What's a gamma? I don't know what they're talking about. Let me just enter a number and move on. Right? 2 suggestions. If you're going to use simulations, go back and review all of those distributions. In fact, I have a paper on my website just on picking distributions for Monte Carlo simulations. So what do you base it on? How do you decide normal versus exponential? I wrote it for myself because I had forgotten so much about the distribution. I said, let me go back and review everything I used to know about distributions. So if you want to do Monte Carlo simulations, at least take a look at the distributional choices, how to pick a distribution for a particular input. But once you've done that, keep it focused. Make it don't take every input cell and make a distribution on it. Pick 2 or 3 or 4 cells. In fact, I did a valuation of ExxonMobil last week where I did a Monte Carlo simulation, but the only variable that I actually allowed to vary across time was the oil price. So I actually spent time coming up with that distribution because I asked myself, do I want to do 5 inputs and kind of disperse my efforts on 5, or do I want to pick the one input which I think makes the biggest difference? So make your judgments on what to do. In the case of Amgen, for instance, you saw the original valuation, right? $73. I tried a Monte Carlo simulation. These were the variables that I built the Monte Carlo simulation around. I allowed the return on capital. Instead of setting it at 16, I set it to a distribution where it ranged from 8 to 25. And the length of the high growth period, I'd use 10. I tried 7, 8, 9. So basically, it's a uniform distribution because I really had no idea how to actually set up a more elaborate distribution. For the return on capital and stable growth, again, I allowed a what if on that, and the reinvestment. The one thing, though, is I did in Crystal Ball, and this is actually a good feature, they allow you to build in a correlation between two inputs. So for instance, you can say when my return on capital is high, my length of growth period is probably going to be high. Or when interest rates are low, inflation is also going to be low. It allows you to make sure that internally your assumptions are not fighting with each other. So those are the 6 variables around which I built this. So I took that original Excel spreadsheet and just made these 6 inputs into distributions. So here's what the output looked like. You know the expected value across 10,000 simulations is? And 10,000 simulations is just, it takes a PC about 1 minute to do it. It's actually pretty impressive. The expected value is about $74, which is actually what your DCF value, which should be really no surprise, right? Because if your distributions are consistent with your base case, the expected value across the simulation should be pretty close. It will not be precisely the same because of the statistical issues in the distributions, but you're going to be pretty close. So you think, why would I waste my time? Here's the useful output you get if you run your simulation right. What's the stock price right now? At least when I did this valuation, $55. Here's a question that you often ask. If I buy the stock, what's the probability that I could lose money? Well, you can actually draw a line at 55, compute the likelihood that this stock is undervalued or overvalued. So if you're doing this across companies, then not only will you get an expected value, you also will get a likelihood that that stock is undervalued or overvalued, a probability that you're right. And that could be useful if you've done the simulation right. Okay? Incidentally, if you're going to buy Crystal Ball, do it in the next 2 months. The reason is the student price for Crystal Ball is, I think, $100. The minute you graduate, it becomes $800. So there are if you want to buy some programs and kind of lock them in at this price, do it before you graduate in May, because it's amazing how much the price of these. Any questions on simulation? So my point is, don't expect uncertainty to go away. It's always going to be there. Only some of it comes from your model. Most of it comes from the real world. Deal with it in a healthy way. Don't put your head in the sand saying, I don't see the uncertainty. Don't freak out and make uncertainty the central theme in your valuation. Accept the fact that everybody valuing this company faces the same uncertainty. You're not the only person out there wondering what the revenue growth will be 3 years from now. Okay? So make your best estimate. Accept that you'll be wrong 100% of the time. That's a scary thought. Right? Just be a little less wrong than the next guy. That's all you need to be. Here was a valuation that truly depressed me. Depressed me in what sense? Well, it's nice to have optimistic valuations, positive growth. It's a valuation I did of Sears in 2008. Right? So clearly Sears' best days are behind it. What's, I think, different about this valuation is if you look at the growth rate for the high growth period, the high growth period doesn't always have to be high growth. It could be negative. It's any growth rate other than your stable growth rate. In the case of Sears, the biggest problem they have is a lot of their stores don't make money. To get them back to health, you actually have to shut those stores down and make it a smaller company, right? That's what Eddie Lampert is trying to do. So basically what you see reflected in this valuation is my attempt to bring what I think has to happen at Sears to make it a valuable company. Shutting stores down. Effectively, if you talk in terms of reinvestment rate, you know what that means, right? Your reinvestment rate will actually be negative. You'll actually be taking capital out of the company as you shut stores down and make it a smaller business. My reinvestment rate for the next 4 years is minus 30%, reflecting the shutting down of stores. The stores I'm shutting down are my worst stores. So here actually having a low return on capital is a good thing, right? Because basically I'm shutting those stores down that actually deliver a really low return on capital. Hopefully if this plan comes to fruition, by the end of the 4th year, what's left of the company should be the more efficient stores, the stores that actually deliver their cost of capital. I'm not going to ask for miracles here. Sears is not going to be an excess return company. All I'm hoping and praying will happen is after these bad stores get shut down, in steady state, they will earn their cost of capital. So what I'm trying to emphasize in this valuation is sometimes you'll have companies, we look at the company, it's quite clear, if you have to value GM, that what you're hoping is actually a smaller, more efficient GM 5 or 10 years out, assuming things work out. And that is effectively what the reinvestment rate and the return on capital are bringing in. So if you have a company that's divesting businesses, becoming smaller, you can still use the reinvestment rate and return on capital. It just works to make the company smaller and sleeker by the time you make it into a stable growth company. So that really is the only key factor in this model that makes it different from the other valuations, is that shrinking of the company. Okay. I don't think I saw a single, there were actually a few DCF valuations where there was negative revenue growth. So, I mean, leave open that possibility. If you have a company that you feel will actually become smaller, have negative revenue growth, negative reinvestment, that's internally consistent because that's what you expect to happen at the company. Quite a few of you also are valuing companies where I know the question, and I could see this coming through in your valuation, was you came up with the value per share, but the question that was in the back of your heads was you weren't sure whether this company is actually going to make it through the next 6 months, or the next year, or the next 2 years. In other words, survival was something that was hanging over your company. I'll give you an example. This was actually a valuation I did of Global Crossing. Actually, the company's still around. I don't even know how it's made it through or what it is right now. But this was a valuation of Global Crossing when it was a far bigger, higher market cap company way back. Okay? But this was a valuation when they were, if not on their deathbed, crawling towards their deathbed. I'll give you a sense of why they were in that much trouble. See how much they lost in the year coming into this valuation? $1.9 billion. Their net operating losses were $2 billion. Clearly, this company had lost a lot of money for an extended period. It was losing, it was hemorrhaging. So I sat down and I decided to value this company. Distressed company, right? Losing a ton of money. We know the rule book to value companies like this. What do you have to do? You have to make the company a healthy company. And at least on a spreadsheet, it's incredibly easy to do. You sit there and you make the negative margin to a positive margin. Your company goes from negative, big losses to big profits. So I followed every rule in the book, came up with a value for the company, and essentially valued the operating assets, added cash, subtracting that. Now, this is a conventional valuation of Global Crossing. The value that I came up with was $3.22. So I made the distressed company into a healthy company, brought down the debt ratio, lowered the cost of capital, changed the company, made it into a healthy company, big terminal value per share of $3.22. Stock was trading at $1.86. Remember that Amazon valuation where I said I was trapped? Stock was trading at $11.50. I came up with the $20 value and I said, in a sense, I was forced to buy. Here, I didn't even think about buying. I looked at that stock price and said, no way am I touching this stock. Which led to some soul searching because, up till this point in time, I'd never really consciously thought about what do you do about distress in a DCF valuation, because DCF valuation by its very nature is an optimist view of the company, right? Every company survives, becomes healthy, and gets to nirvana, where nirvana is the terminal value. The reality is a lot of companies don't make it to nirvana. A lot of companies don't succeed. And this is my value for Global Crossing, assuming it makes it. And there's a pretty hefty chance it will not make it. So I said it would be nice if I could figure out the probability that Global Crossing will not make it. Now, where would I get that probability? It's tough to get it out of the equity market. Equity investors tend to get distracted by all kinds of stuff like growth and earnings and all that stuff. But there is another market that is focused on default, and default alone, right? Which is The bond market. So I went looking for a global crossing bond, and I found one. In fact, if you think about estimating the probability of distress, there are I'll go through three ways, but the way that I'm going to describe to you is based on the bond market. Then I'll go and give you what to do if you don't have a bond market to do it. I found a global crossing bond. It was an 8-year, 12% coupon bond, which was trading at 653. Now we know how to price bonds, right? What's the standard way in which we were taught to price bonds? What do we do? We take the promised coupon, $120, and then we discount it back at a risk-adjusted rate. That's how we normally price bonds. I'm going to suggest a different way of pricing bonds. What if instead of taking the promised coupon, you took the expected coupon? You're saying, what the heck is an expected coupon? The expected coupon is the promised coupon times the probability that your company will be around to make that coupon payment. So if you look at the numerator, what I have is the $120, which is the promised coupon, times the likelihood that this company actually is around in year 1, year 2, year 3, year 4. But now since I've adjusted my cash flows for default, I now discount back at the risk-free rate because it's already risk-adjusted. So I set up the equation. I know the price, I know the promised coupon, I know the risk-free rate, right? What's the only thing I don't know? So in Excel, I set up a solver function, and I solve for that probability that the company won't make it. In other words, I knew the price, I knew the coupon, I knew the risk-free rate. I said, what would the probability of not making it have to be for this price to be right? 13.5% a year. That doesn't sound too bad until you remember you got to survive 10 years to get to the terminal value, right? If there's a 13.5% chance of failing each year, the chance of you making it through 10 years is about 23%. Remember the $3.22 I estimated on the previous page? That's the value for global crossing, assuming it makes it. But the bond market is telling me there's only a 23% chance it will make it. You're saying, what will happen the remaining 77% of the time? Now, the remaining 77% of the time, it's going to be forced to default. If you default, you're going to sell off every asset. In this case, I had to estimate what they would make if they sold all their assets. And since there were a lot of telecom companies going under at that time, I actually was able to get some actual numbers on what percentage of book value these companies delivered in liquidation. They're getting 15 cents on the dollar, typically, because there was nobody left to buy. You take 15% of the book value and you look at what they owed, there is no way you as an equity investor are going to get any money if they default. So here's where we are. 23% chance of the going concern, value is 322. The remaining 77% of the time, your equity is worth nothing. The expected value per share, 75 cents. This is something we've never done in DCF valuation. Because in DCF valuation, we act like the discount rate can carry this burden as well. But discount rates were never designed to carry this kind of risk. This is truncation risk. Discount rates were designed to capture uncertainty about your cash flows in year 3 or year 4 or year 5. But this is the risk that there will be no year 3, year 4, or year 5. And that's almost impossible to bring into a discount rate. If you have a triple B, a single A, a double A, triple A rated company, I'd say build it into the discount rate. You can live with it. But if your company is single B, triple C, double C, in other words, you're opening up the newspaper and you're seeing news stories about will this company make it? It's silly to do a discounted cash flow valuation and hang your hat on it because that discounted cash flow valuation assumes with 100% probability that your company will make it through the process. So it might seem like double counting, but my suggestion is we have a really distressed company, put on a healthy company hat, valued as a healthy company first. Then ask yourself the follow-up question. What is the chance my company will not make it as a healthy company? Adjust the value down. Right? Yes, please.
When you use the risk rate discount?
Because the cash flows are risk adjusted, right? So instead of using the promised coupons, I'm actually using an expected coupon. So if you adjust the cash flows for the likelihood it will not get paid, then you don't have to adjust the discount rate as well. That's why I said it's unconventional. The alternative is you take the promised coupon and you discount back at a risk adjusted rate, which is the way you normally price bonds. Yes?
Can we say that this is a relative valuation because you are using basically market prices in order to calculate?
The only thing I use is a bond price, right? It's not. There's nothing relative about. I mean, we use a lot of data from the market.
It's the market view of
Default. It is the bond market's view of default that I'm bringing into the equity market, right?
Yeah.
And if you're worried about that being wrong, you know what you should do, right? Both are tradable. I mean, if you want to set up an arbitrage, this is it. You buy the cheaper one. So in this case, if you think equity is overvalued and bonds are undervalued, you buy the cheaper one, you sell the more expensive one. but you are using a bond market's estimate of the probability, which actually raises an interesting question. What if your company doesn't have bonds and it's distressed? There are two other ways you can do it. One is if you have a rating for your company, you can estimate a probability of default based on the rating. In fact, Ed Altman every year updates his table that he has where he looks at bonds with different ratings 10 years ago, and he looks at what percentage defaulted over the last 10 years. So if you tell me you're a BBB rated bond, I can go to that table and tell you, at least based on the last 10 years, what percentage of BBB bonds defaulted over the last 10 years, and I can use that as a probability. If you don't have a bond and you don't have ratings, then you're in much more difficult. You have a much more difficult time. Actually, one way in which you can use statistics is going to help you out. You know what a probit is? Have you ever seen a probit? You've seen multiple regressions, right? Multiple regressions, you have a dependent variable and independent variables. In a probit, your dependent variable is actually a probability. It's set to 0 or 1. So basically what happens is, let's say you take 100 companies and 30 defaulted and 70 survived. You set the defaulted companies to 1. You set the companies that survived to 0. Then you look at the characteristics that you think might drive it, the debt ratio, the cash, etc. And then you run something like a regression. But what you'll have then as your dependent variable is a probability number, which means if you plug in the numbers for your company, you will get an estimated probability that this company will make it or will not make it. And you can use that. It's a lot more messy than using a bond or a rating, but sometimes you might have no choice. Yeah?
What are the factors internal to the company or even environment? Wouldn't you want to bring those things?
Like, give me an example.
Management, for example.
What management by itself is kind of behind the surface.
For example, if they just the CEO, they brought a new CEO,
Well, tell me what will change. Ultimately, it's got to be numbers. New CEO is not making the interest payments. I can say new CEO interest payments, right? He's got to change something.
Right.
Right? So tell me what will change, and I'll come up with a number that captures it. So if you think the new CEO is going to make operating income go up, I'm going to put that in. So you can change all the surface variables you want, but unless it translates into actual numbers, your default risk is still your default risk, right? GM can bring a new CEO, but I guarantee you its rating tomorrow is still going to be the rating it has today, right? So you still have to have some real numbers you latch onto. Yeah.
Doesn't your synthetic rating spreadsheet incorporate some of the defaults?
Some of it. That's, I think, one of the issues is when you're doing this approach, if you decide to go this route, you might decide to actually use an industry average cost of capital or a healthy company's cost of capital as your cost of capital for your company and say, you know what, if the company survives, that's what the cost of capital is going to be. That way you don't have to worry about double counting at all, right?
Even from year one.
Even from year one. So, which actually makes your life a lot easier, right? Because you don't have to worry about betas changing, debt ratios changing. What's the chance? So it's almost like a decision tree. Company makes it, company doesn't make it. If it makes it, becomes a healthy company. You can even use multiples, right? You can say a healthy company trades at 8 times EBITDA. That's what my healthy company's value is. Let me attach the probability to it and see what the value is today. See this page? Oh, I don't know why I had a blank page in there. Do you have a blank page in yours as well? Good. That's for notes. That's what I intended it for. Yeah.
Actually, I have another question just
Yeah.
on Sears.
Mhm.
So if you're basically downsizing the company,
Right.
Would you recommend that you look at, because I guess you can imagine which type of business the company would want to shed its business
Exactly.
on.
So your betas might change, or what you're left. You have to look when you get to terminal value. You got to look at what's left of the company,
Right.
rather than what you started off with, right?
But I was thinking in terms of reinvestment, adjusting reinvestment, would you basically have to value the businesses that you potentially be shedding up?
No, I wouldn't even bother. It's not worth the effort because that'll require assumptions about what the sellers are willing, or the buyers are willing to pay you, right? So unless you assume they're suckers and you can sell it to them at a price different from your value, better to not even go there. And if you get some extra value, view it as icing on the cake, right? So just divest, take out the returns on the operating losses or operating income from what you divested, see what you have left at the end. Yes?
Even the distressed companies, you can, besides what you said, you can value them as option, and from there
That'll actually increase the value. That's not going to reduce the value. That's a different issue.
Figure out the probability of default.
No, that's a different perspective. Again, we'll come back and talk about that, where equity is an option in the company, but it's a very different perspective. These are distressed companies where equity investors have actually lost control of the company. They no longer run the company, right? And GM, equity investors don't run the company anymore. The lenders run the company. There's somebody else in charge. What you're talking about is actually an option before you hit that stage. There might be an optionality, but that's a different issue. We'll come back and talk about it. Okay. Any other questions? Yes? It does affect it, right? Because when I attach this to the entire present value, I'm attaching it to the terminal value as well, right? So you could actually, that's a different, did everybody get his question, which is, will the probability of default affect my terminal value? Right now I'm attaching the same probability of default to all 10 years of cash flows, including the terminal value. An interesting other way to do it, especially if you have a lot of bonds outstanding, is just as I compute a probability of default over a 10-year period with a 10-year bond. If you have 9-year bonds, 8-year bonds, 7-year, it's messy unless you have a lot of bonds. You can actually compute probability, because generally speaking, the probability of default is usually higher in the early years. And if you can make it through year 1, 2, and 3, you can expect it to drop off. So you could actually build in year-specific defaults if you, but do so only if you have the information to do it. Right? Last 2 pages actually are kind of loose end valuations. So these are 2 valuations I did, one on September 12th and one on October 16th of the same company. None of the financials of the company changed over that 1-month period. Okay, but the reason I picked September 12th and October 16th is September 12th, that evening was the day Lehman went under, and we saw the kind of ripple effects of the next 4 weeks. So in other words, what I want to talk about is how does the world affect evaluations? Okay? So since I'm looking at the same company, same financial information, I want to focus in on what I changed between September 12th and October 16th. September 12th, I valued 3M. This was before the troubles. See what my equity risk premium is? 4%. Default spread reflects the fact that AAA company, you can borrow at 0.75% default spreads. This reflects the pre-crisis risk premiums, default spreads, and expected growth rate. So basically the value that I got was $84. Stock was trading at 70. Okay? So this is conventional numbers that I would have used in any class up to this one, risk premiums and default spreads. Here are the things that I changed. I changed only 2 things actually, because as I said, the rest of the information hadn't changed. One is I increased the risk premium to 6%. And you can already see that's already would have maybe jumped to 7.5 or 8% if I'd done this in January, but I increased the risk premium to 6%. I used a much higher default spread. The rating hadn't changed, but the default spread are almost doubled. Okay? And for the growth rate, I did reduce the growth rate because you could start to see the effects on the real economy already. So I kind of lowered the expected growth rate to 5%. So 3 changes. The reason I did it was the stock price had dropped to 57, and there was a lot of talk about that's a big drop for 3M. It's become incredibly cheap. Okay? Actually, the stock was cheaper on September 12th and October 16th because if you look at the value per share with the changes I put in, it's gone from $84 to $61. Again, I am not uncomfortable with the fact that my value dropped by almost 30% over a 4-week period, because in a sense you can't keep your doors closed to the outside world and say, I have a value, I'm going to stick with that value no matter what. You've got to be able to revisit that valuation. In this case at least, what's happening to the stock price reflects what's happening to the outside environment, and I'm trying to bring it into my valuation. Okay? So this is something you will struggle with on your company valuations, is if the market starts going up. Many of you use risk premiums of 7, 8, 8.5%. Go back and at least change those risk premiums, see what happens to your value, because as the market changes, your value should kind of at least be keeping up with what's going on out there. Any questions at all about DCF valuations? One point about that distress issue. I know some of you are valuing banks. I don't think anybody picks Citigroup. But you know what's keeping Citigroup's stock price down? In fact, this is something that's been affecting a lot of banks starting about 8 weeks ago when the talk of nationalization first surfaced. Because think about this. I mean, this is not distress, but if a bank is nationalized, what's your equity value going to be? It's going to go to 0. So when I value a bank now, I have to ask 2 questions. One is, what's my value of equity for this bank, assuming it's a going concern? Then I have to ask a follow-up question. A question I might not even have thought about asking 6 months ago or 1 year ago. This is, what is the chance that I'm going to be put out of my misery? And in the case of Citi and Bank of America, what's depressing the price is any time that probability that people think it's, nationalization goes up, it's going to affect the value. It's got nothing to do with the dividend discount model per se. It's that truncation risk coming into play. And last week, one reason banks kind of boomed in price was at least the talk of nationalization had kind of reverted back to the background. But who knows? It'll come back to the foreground again and follow up. It'll be interesting to see how today's announcement with the big will play out, because it is affecting the probability of what will happen to banks and how they will be treated going forward. But this, I think, is an issue around the world now. We face in equity valuations. The notion of truncation risk is up front and center. Companies, we didn't even think about this issue 6 months ago, a year ago, and it is affecting the value per share for these institutions. No questions. That's it for packet 1. We will start on packet 2 on Wednesday.
Just a quick question on this actually. So in terms of preparing for it, so should we be focusing a lot more on, say, what was, I don't know, growth? I guess growth, a lot of what was covered.
Growth, loose ends.